Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 29th of April. I'm Daniel Lam, your host for the podcast. I want you to guess what was the hottest topic amongst my colleagues at the office last Friday. Well, if you believe it was about the strong results from a few members of the Magnificent Seven, or it was about the strong rally last week in the Hang Seng Index, you will be forgiven. Actually, it was all about the dollar-yen, which is always being watched because Japan is a popular holiday destination for people in Hong Kong. And it broke decisively above the 155 level. So the BOJ did err on the side of caution, a term that we coined in our podcast last Monday by keeping the policies unchanged in their meeting on Friday. They cited that the risk to prices is quite balanced at this stage. Now, of course, like we said, after enduring balance sheet recession since the burst of their asset bubble at the start of the 1990s, and they have recently came out of a 30-year disinflationary process, they decided to play it safe. And naturally, this encourages traders to be keeping their shorts on the Japanese yen versus the US dollar. Because after all, the interest rate differentials continue to work in favor of long dollar against short Japanese yen. Now, US inflation has been surprising to the upside, and the Fed rate cut expectations have decreased, and rates have risen anew, acting as a tailwind for the US dollar against the Japanese yen. Now, moreover, the latest US GDP figure last Thursday came in quite below market expectations, and suddenly there is an emerging narrative of stagflation coming back. Now, in that case, the Fed would be stuck between a rock and a hard place. They would not be able to risk cutting rates because that would let inflation spiral out of control, and they would not be able to hike rates to control inflation because that would slow the economy down even further. So this is a potential risk-off scenario, and that would be a tailwind for the US dollar because of the safe haven status. So in the short term, it is possible that the dollar-yen has a few more big figures to run higher, supported by technical indicators such as ADX and MACD. Now, investors may consider buying equities of Japanese exporters as a result, because the key risk of a significant appreciation of the Japanese yen remains limited. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.